In this month's Economic Update, Kaplan Professional Education's Victoria Papandrea presents a special report on the outlook for domestic and global investment markets in 2013.
Welcome to Kaplan Professional Education's monthly Economic Update. I'm Victoria Papandrea and today I'm speaking to market commentator Dr Don Stammer. Don, thanks for joining us today.
Pleasure.
Don, we hear of forecasts for growth in the US being revised up now that housing and manufacturing are improving and some action is taken on the budget. What does this mean for investment markets in the US and globally?
Well, currently the consensus forecast for growth in the US is only growth of 2%. The things you mentioned probably will lead to people increasing their forecast for US growth, and that'll be very important. The US share market's been strong, the price earnings multiples back to normal, but what the US share market now needs to give another boost to itself and leadership to the world market is upgrades to corporate earnings. And if, as I believe we'll see, growth figures for the US are revised up, it'll be good news for earnings, good news for the US share market, good news for world share markets, but of course bad news for bonds.
China seems to have avoided the hard landing that was feared in late 2012. Don, how is that likely to affect investment markets globally and in Australia?
The Chinese economy is doing better than people feared last year, and a very big component of that is increases in household consumption. The new Politburo in China is very keen to continue that because, of course, it gives it political legitimacy if the middle class is doing well and more people are coming into the middle class. Probably China will have 2 or 3 years averaging growth 6.5% to 7.5%, and that's pretty good for the Australian economy. It won't boost our commodity prices, but it'll keep them at comfortable levels. It'll also underpin world economic growth. So overall what's happening in China, along with what's happening in the US, is quite bullish for the world growth and of course bullish for equities.
Now, in the US, Europe and Japan, central banks are maintaining their extremely easy settings in monetary policy and generating liquidity on a massive scale. Don, how is that affecting investment markets and the global economy?
The big theme of investment markets in the last year has been the hunt for yield. Central banks in the big countries are keeping interest rates at very low levels, and people are using some of the liquidity those central banks are creating to go chase shares, to go chase corporate bonds, and the hunt for yield has been on. Clearly, the big central banks are going to maintain easy monetary policy as long as it's necessary. The US is actually committed to keeping interest rates at very low levels till unemployment's down to 6.5%. It's currently 7.9%. And those moves by the big central banks are very important for global investment markets. It means that there'll be plenty of liquidity around. It means that the central banks are doing whatever they can to boost world growth. And once again, that's basically good news for share markets around the world, though there will be wobbles. But the more you look ahead, the more worried you've got to be for bond markets. Already the US 10-year bonds moved up from 1.5 to 2%, and what central banks are doing probably will push those bond yields higher in the course of this year.
The 4 big economic blocs, so the US, China, Europe and Japan, are on different growth paths this year. Will this affect investment markets?
It'll probably have a very big effect on investment markets. Europe has got to pull itself out of recession, and the best Europe can hope for is very modest growth. Japan's throwing everything at trying to get back to inflation and reasonable growth. China will have a good economy. The US probably will have its growth upgraded. What I think we'll see are very different moves in share markets in the different economic countries and by industry. So whereas last year was a year in which a lot of markets moved together, this year we're likely to see quite divergent investment returns across those countries, across individual industries, and within individual share markets across individual shares. So what people have got to allow for this year is greater divergence of returns. Also, with very big differences in growth in the 4 big countries, we'll see some moves in exchange rates this year, probably bigger than we've seen in the last couple of years. And probably as part of that, we'll see the US dollar start to get some confidence back as that economy does better. The Chinese will allow their currency to go up further, but it's going to be a bit of a struggle, I believe, for the euro and the yen.
And just finally, Don, where is the Australian dollar heading this year?
The Australian dollar's got some positives. If world growth is revised up, that's generally a positive for the Australian dollar. But the main reason our dollar has been so strong is that investors and traders around the world have not liked the big currencies, and in particular the US dollar. If I'm right that we see US growth forecasts revised up, some confidence will come back into the US dollar, and that would, I think, bring about a welcome reduction in the value of the Australian dollar. We have to think of the Australian dollar being affected not just by things within Australia, but by things that affect the big currencies. And if the US dollar gets its confidence back, we would see a weaker Australian dollar, and that would of course be good for our industry, good for our jobs, and in particular good for our share market.
Don, thank you so much for your time today.
My pleasure.
And that brings us to the end of the March PD sessions. Thanks for watching. If you have any feedback or questions, please drop us a line at pdcontent@kaplan.edu.au. I'm Ron Wilson. See you again next time.